Hello, everyone. I'm Colin Nicolson, the principal with Withum's Financial Services Practice, and I'm located in the great state of Florida. And I'm here today to discuss with you a trend that's going on in the industry with respect to asset managers looking to Florida and other tax favorable domiciles as a place to set up operations, relocate, and migrate away from some of the traditional jurisdictions where taxes may be becoming more unfavorable to their businesses and to their personal lives. And so we're going to explore that a bit with our head of tax for financial services, Mr. Mike Oates. Mike has been around the industry for a very long time, has actually worked with a number of managers who have made this type of election for their business. And I look forward to getting Mike's insight to help us kind of be more aware of exactly why this is happening and how it might continue in the future. So thanks, Mike, for joining us today.
Happy to be here.
Great. I would say that our first question is maybe you can just walk us through Tax Benefits 101 for managers that maybe are based in a higher tax jurisdiction like New York, and what are they really gaining in terms of tax benefits in terms of setting up a location in Florida or moving to Florida entirely?
Yeah, so I've worked with a number of managers in the alternative investment space, either leaving, New York, New Jersey, Connecticut, California, to lower jurisdictions such as Florida, but there's about 7 other states that are called no income tax states. So it's not uncommon to have a drive to kind of move out of some of the higher tax jurisdictions, and a lot of it resolves around the individual tax rates. How much ultimately is going to be taxed at that level. But to get to that level, you need to understand what's happening at the management company level. So if the entire company isn't moving to Florida or the low tax jurisdiction, then you're only talking about a portion of what's going to be earned at the management company level being subject to the benefit of the income tax savings, especially if the management company is a flow-through entity. So in general, you have to run analysis of how much of the operation will move to Florida, how does it impact the apportionments in the existing state that they're operating out of, and so how much of the revenues can be kind of allocated outside of that state. In general, the incentive allocation that the general partner entity gets, that's going to only be taxed in the jurisdiction where the person's a resident of. So if their main source of revenues is from the GP incentive allocation, that will escape tax even if a part of their business is still operating in New York or California. So it really revolves around just doing an analysis of what they're willing to move, whole business versus portion of it, and then how it impacts the calculations of what they would pay income tax wise.
And a quick question in terms of timing. Is there any time of year that they should be looking at doing a move that's better than others, or is it just purely pro rata?
It's purely pro rata. In essence, there is a carry and it's earned on the last day of the year. So there may be some benefit to doing it sometime before the last day of the year and take advantage of possibly having more of the carry allocated out, but that always is subject to some challenge. So earlier on in the year, the better.
And I've read some articles that suggest, and again, I'm not a tax expert, so I'll defer to you, but just some kind of basic understanding of what the effective tax rate benefit might be. Is it upwards of 20%, 25? Is it 10? Do you have some kind of ballpark to share?
It's generally, the max generally, now kind of ties into the highest individual rate in the jurisdiction you're leaving. So, between California and New York, it's probably 12 to 13%. There's proposal that New York may go up to 14.7 under a recently issued budget proposal that the governor just issued. So, that's pretty substantial, especially now that the state deduction isn't still available in those states, which would, bring down the effective tax rate. So you're really talking about the gross income tax rate. The only entity level tax that comes into play is there's a New York City unincorporated business tax. It's a 4% entity level tax that will paid if the management company is profitable. There is some savings there to the extent that that income can be sourced out of New York to quote a low tax jurisdiction to save some of that 4% UBT tax.
Okay, thank you for clarifying on that. How has this situation evolved over time? I mean, you've worked with managers.
Yeah, I mean, I've worked with managers, for many years, and they're always they're always looking at a trade from the standpoint of can I do a residency trade that makes sense? There was a lot of talk around trying to do something before deferred comp payments came in back into the U.S. in 2017. I think it was a little more challenging based on the way a lot of those deferred comp structures were set up to really be able to accomplish it for New York purposes. But even earlier on in my career, probably the early 2000s, there was a big push to kind of move out. I think earlier on it was viewed as a harder thing to market a fund outside of New York or the big cities. So going to Miami wasn't necessarily great from a marketing perspective or perceived marketing perspective, and I think that's become less of an issue. So I think even the fact from what everyone's doing from working remotely because of COVID, that's also going to drive kind of a continued progress where it's more likely to happen that you can have offices set up remotely from a main office in these low tax jurisdiction, assuming that's where your people want to be. So I think there's definitely going to be a continued push, but we've gone through ebbs and flows historically when people wanted to get out of the high tax jurisdictions.
Yeah, and so for some of the smaller managers, say somebody who's maybe just themselves and 4 or 5 employees, is this something you've seen smaller managers do, or is it kind of more in the domain of a larger enterprise?
It's a combination of both. I've seen some larger managers do it and be able to move an office there, not necessarily move the whole operation. I've seen some smaller guys do it, and they prefer to move the whole operation and get some of the benefit of the cost savings from having a rent space in New York or some of the bigger cities. So that kind of varies. The question always was, when you move to a jurisdiction that doesn't have a lot of fund managers in it to begin with, are you going to be able to find the support, call it the analysts, sort of the talent on the ground in those jurisdictions to really be able to grow a business in the alternative investment space? So I think that's become less of a challenge as more people are willing to set up and operate outside of the big cities. But I know historically, managers were always concerned about getting the right talent when they moved out of sort of the big, New York or some of the other big jurisdictions.
Right, and so now we have the tailwinds of the tax benefit, along with the trend in general of remote working and less dependency upon being in urban centers per se. And so I guess the combination of those two trends perhaps is what we're seeing more of these headlines about this topic. Do you think that the state governments that are, I guess, I don't want losing the managers, are they doing something about this, or
they're losing revenues? And really, that's the main focus of the state governments is either they've got to raise income taxes or come up with ways to attract and keep these people and businesses in their jurisdiction. So, from an audit perspective, they're going to be more aggressive in looking at, if you do move, to make sure that you really change your domicile. And if you still have a permanent residence in their particular state, they're going to want to check and make sure you haven't spent more than 183 days there. So from an audit perspective, getting everything in line as far as, going through a checklist of all the things you need to do to properly change your residency, and kind of making sure you kind of do everything with driver's license, voting, schools, affiliations with clubs, all those types of things that, to demonstrate your domicile is now in, sort of in Florida or whatever other low tax jurisdiction you're looking at. and you've kind of checked the boxes and done everything correctly from that perspective. And then even if you have done everything, states are still made challenge based on whether you have a domicile in their state, and they'll look at a 183-day rule to see if you've broken that. So, I would anticipate states being more aggressive. New York has always been very aggressive. When a big high net worth taxpayer leaves, they're generally going to be audited. But I would think other states like New Jersey and California and Connecticut are also going to be aggressive, kind of coming out of COVID, knowing that they're going to be losing some, high earners, at the state level.
Okay, so it looks like if you are going to make the move or you're considering it, that you'd want to speak to someone like Mike, who can help you with your specific case circumstances and facts, and give some thoughts to more than just the tax impact, because there can always be changes down the road that may narrow this tax benefit. And it's something that is, if you're going to move people and move yourself and all that good stuff, it's a longer term decision. So lots to consider. Mike, any last comments on this topic?
Just a matter of, one, just going through calculating what the benefits are, I think is step one, and then going through the process of what it really means to move, step two, and then analyze the cost other than tax. What's the new rental space going to cost you? What's it going to cost to operate maybe a second office? There is some overall cost to the business, hard costs that'll be associated with that, and maybe some soft costs in having to manage people in two different offices. So really just depending on the size of the organization and kind of managing overall cost that comes into play now too. I think over the last year, we proved that people can work remotely and be very efficient and effective. So, we're seeing that probably ultimately it's easier to kind of do a move like this. And even from the due diligence side of the community, I think everyone's getting comfortable investing in managers who are working remotely. So I think that all adds to the capability of having more movement to low tax jurisdictions over time.
Okay, thank you, Mike. And I'm going to continue on this topic of manager movement and migrations from traditional jurisdictions to others that may be more tax favorable, and look at some other questions and topics related to that that will provide more awareness in terms of things to consider. And so our next segment is going to be me interviewing Mr. Ron Geffner, who is an attorney in the fund formation space and advising managers of a whole host of regulatory and other legal considerations. And Ron will be my guest, and we'll speak to this subject from his perspective in the legal space. So thanks very much and have a great day.
Thank you, Colin.